Thank you so much for joining us. I'm Josh Bartholomew with Horizon Investments. We're grateful that you've taken time here at the beginning of the year in 2019 to spend a few minutes with us reviewing 2018, but really looking forward into 2019 and really what a year it's been on many fronts. I can tell you that we are many things at Horizon, but most grateful for your partnership. This was, in 2018, a banner year in terms of engagement with advisors and opportunities with advisors' clients to serve them. And I must say, on behalf of all of us, Happy New Year, but also thank you for your partnership and for allowing us to be a part of your practices. We look forward to serving you well in 2019. And while we've seen many interesting things happen in the last year, we think there are many reasons to be very optimistic about this year, and we'll get to that. These themes that we've talked about throughout last year, really, especially in the second half of last year, of nationalistic policies continue to impact U.S. and global markets. We had certainly quite a bit of volatility in the fourth quarter, and it seemed like there was no place to hide, and a lot of panic and uncertainty with investors. We understand that, but we also think that these times are very helpful in reminding all of us and all of our clients why planners are so important. And really, it's why we exist here at Horizon to build strategy that support the planner. And the planner, we believe, is no more important now than it ever has been. We believe that it is time to continue to help people remember what their goals are, how they're going to get there, and to have strategy that supports those goals. And hopefully, in partnership with you, we play a small role in that effort. I'm very excited today to have with me again my colleagues Greg Valliere and Scott Ladner with me to do a little bit of a review of the year from an economic and market standpoint, but also from a policy and all things Washington standpoint, review the end of the year in 2018 in summary, but also look forward. And Scott, as I said at the outset, while we've just come through this incredible sort of few weeks of uncertainty and volatility, there's things to be optimistic about, and maybe you could help us with some perspective around that.
Yeah, no doubt. Thanks, Josh. Appreciate it. So 2018 was definitely definitely a tale of two markets. The first half of the year was, after the February period, certainly had some pretty stark volatility in February, but we understand kind of why that happened and the results of it. But after that episode, things were generally okay, especially here in the U.S. You couldn't say necessarily the same thing about things in emerging markets. They were going through some currency turmoil, some political turmoil in certain of those countries. But in the U.S., things were generally okay the first three quarters. And then we got to October 3rd. Powell's little misstatement, which we'll talk about later on here. But that certainly kicked off a wave of selling, not only here domestically, but around the world. And really every asset class, every type of security. 2018 really can be described as a year where there was nowhere to hide. But interestingly, through that fourth quarter, we did see some emerging signs from emerging markets, some emergent strength there, and some really interesting things. We're going to talk a little bit about that as well. But 2018, like I said, was a year where we had just nowhere to hide. This graph is a chart of different Morningstar categories, and it's just counting up seeing the percentages of the different Morningstar categories that had negative total return during the year. What you'll see is 2018 was topped out around 80% at one of the highest years ever. Since 2008 and 94, kind of similar, but it felt like a very heavy year. And that feeling like a heavy year where there was nowhere to hide led to, and along with some pretty negative media coverage, frankly, led to a lot of talk about recession. A lot of people worried about recession. A lot of talk and writing, punditry about the backdrop for global growth. A lot of global growth concerns. And so what we can do here is we can take a look at Google Trends. Everybody in the world uses Google. It can be a pretty helpful way to see and get a handle on what the everyday person is thinking about and feeling. So if you go and do a Google Trend search on words like recession or bear market, things like that, what you find is a really sharp uptick over the last, really over the last quarter. And that kind of uptick where people are just worried generally about recession led to activity. So if you want to understand how people act, you have to understand their psychology. And their psychology was in the fourth quarter was really very negative, as evidenced by this Google, the Google Trends idea. Their activity following that negative psyche was a lot of selling. And this is, these are fund flows in December 18. You see in mutual fund space out about $40 or $50 billion. One of, if not the largest on record. This is at least a record since 2006. And far bigger than 08, far bigger than 15. A lot of liquidation of mutual funds across the space and investment management. This comes out of a psyche. This comes out of people being scared and not knowing what's going on. Now, I know that there's some tax loss selling inside of this, but really what I'm going to show you is we don't think that really matters. We don't think this, certainly not all tax loss selling, but selling is selling. And selling requires that there be buyers to pick up some of the demand. But it wasn't just the retail people. Retail people were certainly scared and certainly listening to CNBC and thinking about recessions and everything else and Googling it. But even professional money managers got to be very pessimistic. So showing that the percentage of investment managers, and these are pros, who think the economy is going to be stronger next year, down at levels that we haven't seen since the great financial crisis. These types of things just don't comport with the reality that we see and the kinds of things that we're showing. But it does give a hint into the psyche of the way people, not only retail people, but how professional investment managers are really considering the markets. And again, that psyche about what the professionals are thinking about markets led to positioning changes on their side too. So this wasn't just a retail phenomenon this quarter. This was, this led to, this kind of investment, professional money manager investment psyche led to them changing their positions. You can see people just blowing out of equities, buying bonds, buying staples, buying the safe stuff. By the way, EM is now considered a safe asset, according to this stuff. But interestingly, what we saw, what we have kind of in summary, is we have retail investors selling out because they're scared about recession. We have professional money managers selling out because they think that the economy is going to be weaker next year. Everybody's selling. That can be okay. But it's not okay when you have a liquidity environment like we had in the fourth quarter, and specifically in December. Mass selling into a massively thin liquidity environment can create the kinds of really exacerbated moves that we saw. Moves that would have been much smaller if not for the very thin liquidity. This graph here is just to show the number of futures contracts on the bid and offer in the S&P 500 E-minis, which is the most liquid equity contract in the world. The number of futures contracts that are on the bid or offer. And so what you're seeing here is that at the end of December, really most of the year, but certainly towards the end of December, that number is minuscule. That means that for a given size order to buy or sell, that same size order is going to move the market a lot more in the fourth quarter, and specifically in December, than it would have at any time over the last 10 years or so, because there's just a dearth of liquidity. People have pulled back. This is what it looks like when you have risk managers managing portfolios, not investment managers managing portfolios. But again, it doesn't necessarily matter the reason why liquidity was terrible. It was just terrible. And if by showing you kind of what the flows look like and what the psyche looked like coming into this quarter, you should not be surprised that we had a pretty wicked quarter with really, really violent moves that seemed way out of touch with the economic and the stock market fundamentals.
Scott, I just think of how nasty this sort of looks, and we set this sort of precedent at the beginning that there are reasons to be optimistic. I think we're building a base that we're going to build from here. But does this mirror any kind of other period that we just give us some context? Does it look like something else that we've seen recently?
Yeah, we think it does. We think you can really harken back to the period from August 15 to February of 2016, and there are a lot of pretty stark similarities and some pretty important similarities that I just want to go through real quickly. Both cases had the backdrop of this idea of global growth fears. I mean, you hear it all the time on the news, like global economy is slowing down, earnings are going to be bad, and blah, blah, blah. We had the same thing in late 2015, early 2016. And I'll show you some data that sort of that confirmed that. So against that backdrop, though, in 2015, we had a central bank mistake. In that case, it was the PBOC, the People's Bank of Japan, China, sorry, that devalued the currency overnight. Really surprise move. That policy mistake kicked off selling. The way you fix a selling spree that gets started with a central bank mistake is with a central bank fix. That wasn't necessary. And in 2016, in February 2016, we got the Shanghai Accord. Not officially, of course, but we all know that it existed. And the Shanghai Accord was essentially a currency détente. Just call off the dogs with currency devaluations. That was the central bank fix that solved the 2015, 2016 selling. This time around, we do still have this global growth fear backdrop, and the central bank mistake was Powell's quip on October the 3rd in the interview with PBS that said we're a long way from neutral, essentially implying that the Fed's going to continue hiking rates far more frequently than the market was previously suspecting. That mistake may have just gotten solved. We'll see. When he was on stage with Powell and Yellen, with Yellen and Bernanke, he basically did a dovish pivot and came off those and started talking about flexibility. Flexibility is the word that the market needed to hear in order to solve the policy mistake that Powell had when he was implied that the Fed was going to continue hiking on October 3rd. So we definitely had a central bank mistake that started the selling this quarter. We may have just gotten the fix. That's our thinking, at least.
So I always think about it in terms, Scott, of what advisors feel and their clients feel. This feels like 2015, but I think you're making the case that things are far better now than they were in 2015.
Yeah, I mean, we think it's kind of not close. So we don't actually spend a ton of time looking at macroeconomic data, but because it's slow moving. But you can learn something. You can get some confirmatory evidence and really get some big picture stuff out of it. And the fact of the matter is, like, we're nowhere near where we were in 2015. In late 2015, there were actually some reasonable reasons to be worried about global growth. Just a few things we're citing here. That then the top left, Goldman Sachs has a current activity indicator for the United States. In 2015, the yellow box is the 2015-2016 period. That was declining. It was declining fairly rapidly. We're not seeing that kind of thing right now. Below that, year-over-year change in railroad plate carloads. How much stuff's getting moved on the rails? It's kind of old school manufacturing data series. But in 2015, 2016, it went pretty starkly negative, just like it did in the previous recessions. Not even close right now. It's still a lot of heavy, good manufacturing activity in the United States. Top right, retail sales. What do we always see in recessions? Consumer gets unhealthy. They start pulling back. They start getting scared. When they hear about recessions, you start saving more. You start spending less. All that stuff. We just printed record in retail sales. This is not the picture of a consumer which is scared, a consumer which is pulling back. The kind of thing you need to see before a recession. You always see before a recession. We're not even close. And then if you just look at the Conference Board's index of leading economic indicators, again, these are leading economic indicators. They tend to turn pretty starkly south before coming into a recession. We're just not seeing evidence of that right now. So from just the broad-based economic standpoint, we're not seeing the types of things you'd expect to see if the U.S. was actually heading towards a recession. We're just not close right now. Further. So that's the economy. If we look at the stock market, again in 2015 we had an earnings recession. This is sales growth for S&P 500 companies. 2015 sales growth was negative. There's a legitimate fear there that we could be going into recession. In 2018 we just had record sales growth. Now it's not going to be record next year. We're probably at peak in 2018. Doesn't mean we're going negative, and we're certainly not. So it's sales growth very, very healthy out there for the S&P 500. And you can't really monkey with sales numbers. You can monkey with earnings numbers, but even still, earnings growth is still for the S&P 500 expected to come in between 6 and 8% this year. Again, we're not looking for an earnings type of recession. We're not looking for a sales recession. This is a pretty healthy economy with a pretty healthy stock market. It is off peak. We acknowledge that, but recession fears we feel are way overblown.
So Scott, I think we appreciate. I certainly do the perspective that helps us believe there's reasons to be optimistic, and certainly to have the idea that this is a different market than we had maybe in 2015 and 2016. We still get lots of questions, though, Scott, about central bank activity and in particular the reduction of balance sheets. Give us some perspective around what fear there should be around that concept and its impact on the market?
Yeah, I mean, that is something that we get a lot of questions about from advisors and other folks. This is something that I borrowed from our friends over at Cornerstone Macro, Danny Kirsch and fellows. But this is the combined. So yes, the Fed is reducing its balance sheet very slowly, but they're reducing, and people are making the assumption that as QE, as the increase in the Fed's balance sheet helps stock markets out, certainly then a reduction in the balance sheet should cause stocks to sell off. Just not really quite the case. One, the pace of the tightening is very, very small. Two, really need to look at the entirety of the central bank complex. This is still a global economy. And when you look at the global complex, we still have the BOJ and the PBOC in easing mode. They're still adding to the balance sheet, and that's helping offset some of the tightening that we're getting from the Fed and ECB. So when you look at the combined activity of the central bank balance sheets, it will be smaller next year than it is this year. We don't believe the magnitude is all that big of a deal. So this is not the A1 concern for us here right now at Horizon.
Well, Scott, I really appreciate the perspective. I know our advisors do, just from a market level view, sort of the review of 18 and coming out of it into 19. Certainly, we're, I think, all excited about what the market's done at the beginning of this year, but your perspective is helpful in sort of justifying why we're seeing what we're seeing and what maybe to expect as we head into the rest of the year. And Greg, while I knew Scott didn't have any shortage of content to cover, boy, you certainly have plenty to go through in terms of your perspective around all things Washington and how they impact Wall Street. As it is our hallmark, we run a firm here that's multidisciplined and that we look at the perspectives of different people to make a judgment about the markets and where they're headed and where the opportunities and risks are. Greg, why don't you give us some of your feedback as we think back on 2018 and as we move into 2019?
Well, it was quite a finish, and I guess I would start by following up, Josh, on what we just heard from Scott, and that is at the darkest point in December, the darkest part of that month, there were four big stories that all seemed to be really gloomy, and they all look better now, just a few weeks later. As Scott said, I think the recession fears are greatly overdone. As someone who travels around the country all the time, I see so many sections of this country that are red hot, so many cities, Charlotte, where we are, you look at Nashville, you look at Austin. So I don't see a recession. We're not growing at 4% that we had last spring, but that, of course, wasn't sustainable. Secondly, my take on the Fed would be that Jay Powell was not pressured by Donald Trump. I think Trump's rhetoric was irrelevant at the Fed. What the Fed was affected by were the markets, and I think the markets sent a very clear protest, a signal that the Fed's got to cool it. And we're seeing that now. We've got FOMC minutes a little while ago, about 20 minutes ago, very dovish, very well received by the markets. The Fed saying they're going to really take their time on further tightening. So that's a big change from mid-December as well. Then there were two other stories I want to spend a minute on. One, of course, is a great fear in the markets, and that would be a trade war with China. And I do think they've made real progress in the last 72 hours. We still have a ways to go. There still has to be a really tough enforcement mechanism to show that the Chinese are sticking to what they would pledge. But I think a lot of ground was broken on the Chinese buying more U.S. products. The U.S., I think, has some assurances that will be firmed up when all sides meet again, probably at the end of January. I still think we can get a rough agreement in principle by early spring. I'm not sure we're going to meet the president's target, but those deadlines can be moved. But I do see things looking better with China for two simple reasons. Number one, the Chinese can clearly see their economy sliding, their manufacturing sector weakening, and if there's layoffs, it could lead to social unrest, which is, of course, the greatest fear that Xi and the communist government has. And on the other reason that I think we're going to get a deal is that Donald Trump got a pretty clear and loud message from the stock market that this market doesn't want a trade war. Trump, I think views the market as the arbiter of his policies, and he wants a deal. So I feel much more optimistic about that. And then finally, the fourth part of the component is the shutdown. I think we've got a few more days to go, but it's going to start to bite. Whether it's 800,000 people not getting paychecks, or maybe the lines get longer at security clearances at airports, farmers not getting price supports, on and on and on. I think that there's going to be growing defections in the House of Republicans deciding they want to pass bills to keep the government open. So the president probably will embrace a call that this is an emergency. That could give him a pathway out of the shutdown as we litigate the entire issue of whether this is really an emergency or not. So even on that messy story, I think things could get better in the next couple of weeks. Final thing I just say about these four big themes, I think what really stands out is that Washington's not affecting the markets. The markets are affecting Washington. Sort of the tail wagging the dog right here. The markets wanted Powell to cool it, and he had to respect it. The markets want Trump to get a China deal, and he respects that. I think it's a good story that what the markets want to see is starting to happen in Washington.
Greg, if I could just ask a couple of questions that I know have been asked of us. Just in summary, I think what I'm hearing from you and from Scott is that just in general, all the things that we were wringing our hands about and worried about in the fourth quarter, specifically in December, are all of a sudden much less worrisome today.
Yeah, I would say, and I think Scott would agree, that, we live in an industry that has to climb a wall of worry. I mean, there's no shortage of things to worry about. I do worry about a messy Brexit in March. I do worry about just the staggering size of the budget deficit, with nobody in either party really giving a damn about it. And we maybe have to spend 30 seconds, Josh, on Mueller. We've not heard the end of him. He is going to have a report out this winter, probably indictments. I continue to feel there are not 67 votes in the Senate to convict, but it's a very new House with a lot of aggressive members who I think would love to subpoena and have hearings and maybe even consider impeachment. But impeachment is one thing. Conviction is the big story, and I don't see that in the Senate. So we still do have some things to worry about. I just think the fundamentals look a heck of a lot better than the doomsayers have been saying for the last few weeks.
And all that we've just presented in the last 25 minutes, you would say, notwithstanding the Mueller investigation, whatever comes out in the balance of this year regarding Mueller, likely not to have much of an impact on markets. Would that be your assessment?
With one caveat, Josh, and that would be, this president has a famous temper. If there were indictments of people close to Trump, I won't mention names, but there's a lot of speculation. Trump could get furious and say to Mueller, "You're fired," or he could say, "I hereby pardon everyone." And that would perhaps elevate this as a crisis. I think a lot of Republicans who have hung in there with Trump, including Mitch McConnell, might say, enough is enough. You can't just fire Mueller. That could make it a crisis the markets have to worry about. But I think for now, at least, Mueller has made it quite clear that he doesn't feel he has the authority to indict a president. He's going to dump all this stuff on Congress. And I think Trump's support in the Republican Party is so overwhelming, 85% approval rating among Republicans, that the Senate will not have the votes to actually convict him.
Well, Greg and Scott, thank you so much for joining us today. As you all know, our clients expect every quarter us to come to them with information that's relevant in terms of a review of the quarter we've just gone through, and certainly the new quarter. And as we kick off this year, as I said before, we're so grateful for your partnership and for your time today. This is a formal way for us to communicate. We do other things that you should be on the lookout for. We'll have a Focus magazine that will be coming out in the next couple of weeks, as well as our quarterly video, which will also feature Greg and Scott and Robbie Cannon as well, So please be on the lookout for those things. But if there's things that we can help you with more specifically, questions that you might have just in general about comments today, or questions that you have in general about the markets or our strategies, please don't hesitate to reach out to us and to our team. There are a variety of ways to do that. You can reach out to our sales desk at 866-371-2399. You can also email our team at sales@horizoninvestments.com. Those sales folks can help you with better understanding of our goals-based strategies, which optimize around risks in the market that pertain specifically to a client where they are, whether that's in the accumulation or gain phase, the sort of in between accumulation and distribution in the protect phase, or if they're spending. We run strategies that are designed to optimize around the risks those people face individually. If you need to learn more about that or you want to understand that better, our sales team can help you, but they can also put you in touch with our team about market insight and certainly context if you need it. So don't hesitate to reach out to us. Be on the lookout for the materials that are coming. We'll obviously be coming back to you again at the next quarter. We put a lot of information and content up on our website. It's a great place and a repository of really good information and collateral. That's horizoninvestments.com. If you haven't had an opportunity, I just want to make a quick plug. We've made several enhancements to our technology tools on that website. I would really encourage you to take a look at those tools. They're incredibly helpful, we think, as you engage your clients as it relates to strategies that Horizon offers. Thank you again so much for your time, Greg and Scott, and thank you to all of you for your time and your partnership. We look forward to serving you this year in 2019. Again, Happy New Year, and we look forward to talking to you throughout the year.